Here is how the Chinese CSI 300 index, which contains the 300 blue chip companies of China, compares to the S&P 500 index over the last 5 years. The Chinese economy did not recover yet from the aftermath of COVID, and the Chinese stock market performance reflects that. In this video, we'll see how common sense can be used to potentially avoid disastrous investing decisions. Here is an interesting Wall Street Journal article dated February 8. The article discusses the growing issue of deflation in China, with consumer prices experiencing their sharpest decline in over 14 years in January 2024. Various economic challenges in China, including slowing growth, real estate crisis, struggling exports, and stock market volatility, contribute to the current economic problems. Falling prices are evident across both goods and services sectors. Deflation poses significant economic risks, including reduced corporate profits, delayed consumer spending, and reluctance to invest or hire. While some economists believe that government stimulus efforts and easing pressure on food prices could reverse the trend, others see signs of a deeper structural issue resembling a balance sheet recession, similar to the Japan's lost decades scenario. Burned by years of underperformance in Chinese domestic stocks, local investor appetite for overseas equities is running so high that it is fueling huge price distortions in funds tracking these assets. At some point, Chinese traders were willing to pay as much as 40% more than the value of the underlying assets in some ETFs in order to obtain exposure to foreign stocks. That triggered trading halts in a number of ETFs as well as purchase limits. China's top securities regulator has also limited short selling in its latest effort to stem a protracted $6 trillion stock market rout that began in 2021. Trillion with T as in tango. Retail investors who have lost faith in the domestic equity market have coined a slogan: put your trust in the fate of the nation, but put your money in the NASDAQ. So that was it for the macroeconomics aspects of things. Let's get down to the weeds now. Ehang is listed on the US NASDAQ, but makes most of its revenue and growth projections from Chinese state-backed entities. Their order book is all but clear. Their biggest Western prospect is United Therapeutics with 1,000 units on order, but even that prospect has gone silent a few years now, with a former Ehang employee saying that the deal was dead. The remaining of their Asian prospects happen to be entities with no background or previous aviation-related activities. For those who don't know what I'm talking about, check out my video titled Ehang versus Hindenburg Research. So by and large, when you invest in Ehang, you are betting on the Chinese economy. And that's fine if this is what you want to do. But if you don't want to bet on the Chinese economy, then investing in Ehang is nonsensical unless you have the contrarian bug. What's the contrarian bug? It's betting against a stock or an economy that's going up, or buying into a stock or an economy that's going down. Of course, things can change quickly in this day and age. That's why having good risk management is essential. But the current picture suggests an exodus from the Chinese stock toward the US stocks. For the time being, I myself choose to follow the money. As always, this is not investment advice, and see you in the next video.